Hey, this is Sasha. Thanks for joining me in today's video. And what I want to share with you today is kind of the Buffett approach to buying and accumulating stock. And it's through doing it with options. So if you're brand new to options, I'm going to show you how to pick up stocks at a lower price than just buying it on the open market. Stay tuned and you're going to get paid to wait. All right, so those of you that are following Warren Buffett's strategies, want to go ahead and invest in stocks or in the stock market, you probably know and understand that, hey, he likes to buy companies and hold for life or for a very long time. And then normally he gets money through dividends, through stock appreciation. Those are the main things. Now, a lot of people talk about this strategy and this concept, earning the money, but they don't necessarily talk so much about how do you acquire the companies? How do you acquire the shares? How do you do it properly? Now, of course, you could just go out and just buy it and not worry about it, but I'm going to show you a smart approach to getting it at a lower price and getting paid to wait by using options. So let's check this out. All right. So say, for example, you want to go ahead and buy a certain stock. Now, normally, if you're interested in, let's say, McDonald's, and you want to go ahead and buy it, and let's say it's trading at $185 a share, well, you just go ahead and buy it. And now you've got 100 shares or 10,000 shares at that $185 price tag. Now, this may all sound fine and dandy, and now you can go ahead and accumulate some dividends with time. But what if I could tell you, you could go ahead and look for that same stock, but now you could go ahead and sell options against it and get paid to wait. So you get paid to wait, and you can get this stock at a lower price. So say, for example, 165, because maybe the stock price is a little high. Maybe it just keeps heading higher and you don't know when a good pullback is and you're trying to wait to get it at a lower value. So here's the way that this strategy works. Number one, you get paid to wait. Number two, if the stock stands still or it goes up, then you go ahead and collect your money and you get your premium, and you can continue doing this strategy month after month. So you go ahead and do this kind of every 30 to 60 days and just keep doing it until that stock eventually will pull back. So when it does pull back, so if you have a pullback, it hits your price or your ticker. This would be kind of your strike. It hits the strike, and you get assigned the shares. And by doing this, you need to have enough money in your account to buy those shares. So you got to have enough cash to be able to buy it. And the strategy I'm going to share with you, this is called a cash secured put. So you're going to be selling cash secured puts, and you got to have enough cash to be able to cover that. And ultimately, you need at least 100 shares of a certain stock to be able to buy it at that price. So if you're dealing with something like, let's say, $5 a share, well, you need to be able to have $500. If the stock is $50 a share that you sell the strike at, you need $5,000. Make sense? Because you need it times 100. So that's really what's going on when you do this strategy. So here's what we're going to do is I'm going to show you on the trading panel and platform the way that this works. Let's just go ahead and dive into it. All right, so here's what we're going to do is we're going to take a look at Starbucks. And if we look at Starbucks, the current price of Starbucks is $63 per share. So if I want to go ahead and purchase this stock, we're going to go ahead and look at $63 per share times 100, and that'll give us $6,300. So we need to be able to cover or have enough cash to cover this amount. So in order to do this, let's say I want to go ahead and purchase this stock at a lower price. So how do I get paid to wait? The way that you do this is you sell cash secured puts against this. So that would be at the $50 mark, and you can go ahead and choose what price you're interested in getting them. But let's say I go ahead and open up my options trade grid. Here's Starbucks, for example, and I could go out 52 days, 87 days, 115 days, and you could go even further if you like. But let's say we go out to the 52 days, and here I have my puts. On the right side, I have my calls on the left side, and you can see here's all the different premiums. And right now, since the current price is around $63 a share, you could go ahead and sell the 60s, that would be your strike price, and you could get $5.20 for it. In other words, multiply that times 100, so you get, and then you can see the price is wiggling, you get $505. So if we're selling it, you'll make $505 for one contract, which means you're controlling or selling 100 shares. You could go out to the 55s or the 50s on the strike prices, and the further out you go, the less that you make. But of course, as you go further this way, you make less, but you have a higher probability at this level. If you get closer to the current price, you basically make more, but it's less chance of success. So it's just a question of where you want to get to, and your probabilities and chance of success is noted right here based on the probabilities that are already outlined. So take, for example, this one at the 45 level, it's a 22 if you're a buyer, 22% chance of success if you're a buyer. If you're a net seller, just do the inverse of that or subtract 100, and you get about an 80% chance of success, or 78. So here we'll go ahead, we'll sell this one, and we'll say we'll sell the single, because that's what we're doing. And that means I would need enough cash to cover this stock, since we're doing it at the 45, to cover 100 shares at $45 per share. So in the end, what you would be paying once you get assigned is 45 times 100. This would give you $4,500. And you can make, based on the premium, $1.65, which again, if you multiply by 100, you can see this gives me $165 on the trade grid. So here, taking a look at this risk profile, you can see if the stock stands still, you make money. If the stock goes up, you make money. If it pulls back a little bit, you can still make that $165. But once it hits under $45, you will get assigned, and you're going to have and see 100 shares of that stock inside your account, and they'll deduct that $4,500 from you. Every single day you make $4.66, which is the theta here. And with time, this white line right here will get closer and closer to your green line. And at expiration, you just collect the premium. You don't have to do anything. You can just let it expire. Now, if it goes against you and you see things are moving and you don't want to get the shares assigned, of course, you could go ahead and get out of it early. You don't have to stay in the trade. But if you do it too soon, like let's say it just happens in the next few days, you could be out with a loss, because now those option contracts are worth much more to the buyer. So anyways, this is the way you could do it, and you could do this on many stocks. And just remember that one single contract controls 100 shares, so you'll be assigned 100 shares once this get assigned. But if the stock continues to head higher, you could do this time and time again, month after month, or every 30 or 60 days, and collect your premium. So you could do this on Starbucks, showing you the same example here on McDonald's. Let's say the current price is 157 right now. So there's 157. And then if I want to go ahead and sell the 125s, I could do that. This is 52 days out. I could do something like this. And here again, I would make, in this case, $4.25 on the McDonald's. So that means $420 as that continues to head higher. Now, take a look at the McDonald's chart. You can see right now the current price is 157. So there we go. There it is, 157. And if I sold the 125, that gives me quite a bit of room, 10, 20, almost 25, 30 points from where it is now. Basically, what you're doing here is waiting and getting paid to wait for that stock to come back to you. And you would do this if the stock price is really high, or maybe let's say it's sold off quite a bit and you're not sure it's going to go lower, so it allows you to get further and wider. The key thing here to remember is that you have to make sure you have enough cash in your account that once you get assigned, because it could happen the first month you do this, it could happen the third month, the 10th month that you do this, eventually you'll probably get assigned if you do this long enough. Unless, of course, you get out of it earlier or ahead of time before you get assigned. But at that point, usually you get a little bit of a hit or loss if there's not enough time decay that worked in your favor. So in either case, this is the strategy. It's called a cash secured put. You're selling a cash secured put. and you have to have enough money and cash in your account to be able to cover that. Good to do as you start to accumulate more and more shares and you have enough cash in your account. You could also reduce your margin requirements by buying protection further out. So if I go ahead and buy a single one just a little bit further, you can see I go ahead and reduce that risk and exposure, but this is beyond the scope of this video. So it's just something to think about as you look to selling vertical spreads. Anyways, thank you so much for joining me. Remember to hit the subscribe button right here on the face icon, or join me on my newsletter list by clicking the link over here. Thank you so much, and I will see you next time.